All right, guys, we're going to be talking about selling options for income. This is a popular topic. A lot of people talk about it, but no one executes selling options as well as I do. I've been selling options for almost 10 years now. When I first started, I wasn't selling options. I was buying options. I was not getting the best results. But what I want to show you right now is the different positions I have and talk about selling options for income. So many people get this wrong, okay? Even if they understand that selling options provides income, they don't know the proper way to do it. They don't know what delta to pick. They don't know stock selection. They don't know how to manage the position. So I'm going to be talking about all these things in a step-by-step guide on selling options to make $10,000 per month. $10,000 per month is absolutely possible. In fact, I have a student. I've mentioned him many times on the channel. He's doing $6,000 a month. He's not at $10,000 yet because his portfolio is at $300,000. So he's making 2% per month. If you don't think that's a lot, well, you're pretty much at the wrong place. Go to your nearest casino and start gambling, because 2% per month as you scale it up over the long term is actually a really good percentage return. If you look at the stock market, 10%. So how can option trading and how can selling options specifically make it 2% per month? Well, I focus on two strategies, kind of three if you want to think about it. Selling puts, selling covered calls, and the wheel strategy, okay? This is just basically selling options 101, okay? If you want to sell options 101 to make $10,000 a month, all you need to do is sell options on good quality companies, okay? As you will see here, I'm doing this on Apple. I'm doing this currently on Snapchat. I'm taking a little bit more risks on American Airlines, on Starbucks, Palantir, Walmart, Amazon, and I have more stocks here. This portfolio, by the way, has done really, really well. I've taken the portfolio from 1.7 million to 2.24 million. It's had some volatility here, of course. I've had some pretty big losses. I have tried some interesting things. However, I've had amazing results. And if I go to positions right now, you will see that all of my positions here are option selling. So the reason why this is all negative is sell, 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 etc. Right? You get the point. I do have 2,000 shares of QQQ in this portfolio. But overall, selling options works. The reason why it works is because options are expensive. They're overpriced. This is something that I learned at Goldman Sachs. It's proven. It's a fact. Now, why is it overpriced? Why are options overpriced? Well, there's actually a few reasons. One of the biggest reasons that options are overpriced is because one theory is pension funds or big institutions, they have to hedge their portfolios. So they're buying put options. And because there's so much volume of buying put options, then they're increasing the price. And when the prices are high, well, you know what to do. You sell those options and you make money. And since prices are high, you get to capitalize on that. Now, also, selling options just is amazing because you get to buy stocks for cheaper than they're worth in the market right now. So one of my favorite strategies, if not the best strategy ever, is just selling put options. Because when you sell a put option, you are committing yourself to buy a stock. However, say a stock is at $177 and you're selling a put option at $170. So you're getting a $7 discount. Not only are you getting a $7 discount, you're actually getting paid to buy a stock for cheaper than it's going at in the market right now. So because you get paid to buy a stock for cheaper, that's literally a no-brainer strategy that you should be using. So I originally read this book, I forget the name of it, but it was essentially around getting rich by selling options. And when I started to really understand how to do this, and when I was at Goldman Sachs, I was looking at delta. For me, the best delta is probably 30. It's a good sweet spot. It's a good premium without being too high, okay? If you do a 50 delta, you're very likely to get assigned on a sell put. If you do a 10 delta, well, you're very unlikely to get assigned, but the premium will be very low. So for me, I like to get a sweet spot. I just start off selling options with selling puts. Okay, selling puts all day and all night on good quality companies. So here you can see that I am selling some put options on Snapchat. I think social media is an interesting play. I got some sell puts on Palantir. I'm up $819. Another sell put on Palantir, Triple Q. All right. And then, I currently don't have any more sell puts in this portfolio because I'm very, very currently heavy on Apple. That's just my bias. But you can just sell puts on 10 to 15 different stocks. That is my recommendation for selling options for income. You always want to diversify and sell options on good quality companies and not over leverage into one. Of course, I'm breaking rules. Then again, I'm a multimillionaire professional. I know exactly what I'm doing. And I have more money than I know what to do with. And that's not being cocky, or maybe it is being cocky, but it's because I have the experience and I know what I'm doing. If you don't know what you're doing yet, you want to diversify more. If you want to get more concentrated like me, you have a big bet to do, perfectly fine. Just make sure that you have the risk management and the risk appetite to take that level of risk. Now, for me, doing this much of Apple is not really a risk because I think Apple's going to recover. I literally have no fear whatsoever. Apple can go up to $180 or even $200 in the next 6 to 12 months. The biggest thing with selling options is you always want to go out of the money, because when you go out of the money, the chances of getting assigned are less than 50%. So even if you do get assigned, the worst that happens is you get to buy a stock that you like anyways. So very oftentimes when I go on my Discord calls, I'll sell options. On Mondays, I have a live coaching call. I'll just sell on, a few different stocks, and it'll just be easy money. I'll either do weekly or I'll go 2 or 4 weeks out, sometimes even 2 months out. Now, the duration that you go out really depends on your lifestyle and your time flexibility, okay? So what I tell a lot of busy professionals is just sell puts that are, 2 months out, because whether you collect, $10,000 in 2 months or $5,000 in 1 month, or, $1,250 per week or $225 per day, those are all the same numbers, right? Or I think I did the math in my head correctly. They're all the same numbers, right? So it doesn't really matter. You can even go 1 year out. Let's say you go 1 year out and you make 60 grand. Well, perfect. Just go 1 year out and then go relax or go keep working or go spend time with your family. So for me, selling options is a really passive way to make money. I mean, it's the most passive way. I've talked a lot of trash on real estate because it's a lot of work. Sure, you can make money with real estate. You can make money in many different ways in this world. But the most passive way, I don't think anything is truly super passive, but the most passive way is to probably have some dividend-paying stocks, sell some covered calls on them, which I've called the double dividend strategy. On the YouTube channel, I call it the double dividend strategy. Let me pull it up. But it's either the double dividend strategy or you can just sell puts and calls. It's called the double dividend strategy. Pull it up right now. Invest with Henry double dividends, I believe. So you can do covered calls on high quality stocks like right here. So for me, that's going to be Kraft Heinz. That's going to be other really good quality companies. In fact, just watch this right here on double dividend strategy. Now look, whether you sell puts or you sell covered calls, both of them are very similar. The reason why they're similar is you're putting out a bunch of capital. You're getting a premium up front. With covered calls, you have some upside. With the sell put, you don't have upside, but you get about the same premium. Let me go over an example and show you why selling a put and a covered call is very similar. So if you're thinking about what should I do, should I sell a put? Should I sell a covered call? Actually, the point is that they're very similar. And here's an example. Okay, so if I go to Apple options and then I go to sell put, we'll just start off with selling a put. Okay, we'll do at the money. All right, so let's just go out to some future date. Let's just go to let's say May 17, okay, as I'm making this video. If you're watching this future, it doesn't really matter. Just an example, just copy the logic, the blueprint, okay? So sell put. So if I sell a 170 put, you can see here, I'm going to get $5.60, all right? Cool. Now, what would happen if I would sell the 170 put? Well, the 170 call. Well, here I'm getting $6.60. So the difference here is actually kind of significant, but at the same time, it's very close. You can see how they're very similar. Here, the 170 call doesn't really give you much upside because the current stock price is $169.91. It's 170. It's 9 cents off. Essentially, you can make 660 or you can make 560. So here, actually, you can see a skew. This is actually pretty interesting because in theory, these two options should be about the same. But Apple currently has a bias on the calls, which is actually a bullish sign that the stock is going to go up. Good for me. I have a lot of 10,000 shares of Apple, okay? So there's actually a bias in the option market right now that Apple is more likely to go up. That's why the calls are priced more than the puts. But if I go shorter term, which a lot of you guys are enjoying shorter term trading, so let me go to 10 days of expiration, okay? So if I go to a 170 put, it's 209. And if I go to sell call, it's 224. So now the difference isn't that much. Now the difference is only about about 15 cents. So this is what I mean. Very similar in risk and reward. So if you look at a sell put, this is what it looks like. You can make some money, but you're really capped. And actually, if you were to look at a covered call is actually going to look exactly the same. It's actually going to be the same payoff. You're going to be capped right here at 170, and you're going to make, instead of 209, you're going to make $224, right? Because that was the premium there. So you're going to make $224, a little different than 209, but essentially your break even is still 170. And if it goes down, you still end up losing money, except here your zero profit isn't going to be 167.91. It's going to be 167 minus 15, right? So that's going to be 76, right? So 76. So it'll be 167.76. Very similar, basically like the same thing. So whether you're selling puts or covered calls, the main thing that you want to focus on is picking a high quality company, a company that's going to maintain its value, hopefully go up a little bit. Maybe it'll go down a little bit. It actually depends. If you want to acquire the stock for a good price, you sell a put, it goes down a little bit, not a problem. Covered call, if you think the stock will go up a little bit, you can actually build yourself a little bit of room for upside. So for example, the stock of Apple is currently 169. Let's say that in the next 10 days, you think it'll go up, but it won't go up past 172.5. So you would just end up selling an option at 172.5. And if you have a big enough portfolio, you just do this on multiple positions. It's only a matter of capital and time to make $10,000 a month. Really just capital. If you want to make $10,000 a month, I think that you can make anywhere from 2 to 3% potentially. I mean, if you want to get really volatile, you can make 5 or 10% per month. So if you want to make $10,000 per month on the very, very low end, you could have 100 grand and go super aggressive. I don't recommend that. If you want to make 10 grand a month and be super conservative, you would have $500,000. If you want to take a medium amount of risk, you would need anywhere from 100K to 500K. Closer you get to 500K, the safer the strategy would be, the safer amounts of money you will make. When you're selling a put option, the lower delta you go, the safer it is, but the lower return you will get. When you're selling a covered call, the higher the lower the delta, the more upside you have. So the more room you have for upside. However, your premium collected will also be lower. If you want to master puts, which I think is one of the most important strategies, then you should check out this video right here, right now.